We're also watching Disney shares taking their worst tumble in nearly 4 years today after a rare top and bottom line earnings miss for the company. After Disney reported earnings yesterday, the media giant posted adjusted earnings per share of $1.35, well below the consensus estimate of $1.75, on revenue of $20.25 billion, which was also lower than the $21.44 billion expected. Now, CEO Bob Iger blamed the weak quarter on the pains of integrating Fox's entertainment assets since Disney's $71 billion acquisition closed back in March, as well as reduced licensing revenue Disney would have brought in if it hadn't pulled its content from other platforms as it gears up to launch its own streaming service in November. So is this the rare sign of continued pain ahead for Disney, or is it a perfect buying opportunity? Here to answer that question is Gerber Kawasaki Wealth Investment Management CEO and friend of the show, Ross Gerber. Ross, thanks so much for taking the time, first of all, but it's not like Disney to lay an egg like this on an earnings report, and Iger actually called this, and likely next quarter, a, quote, transitional quarter, so that's really what he's framing this as here. Are you surprised at the pain, though, in terms of looking at the acquisition of Fox?
I mean, not really when you look at the size and scope of what Disney's doing right now. I mean, of course, anytime you try to integrate large assets into an organization like what Disney's doing, there's, first of all, some, rotten eggs like, Dark Phoenix that you got to deal with. And then you've got, some $200 million in layoff costs and other things. So, they threw everything out this quarter that they needed to throw. It's the typical, throw everything out in a bad quarter so you can kind of clean the slate and move forward. But this is really just a sideshow to what's really happening at Disney. Disney has plenty of cash flow and money to pay for this investment in their future. But if you go back a couple years, Disney was just stuck on cable channels. And now they're about to launch the greatest streaming service ever, and that's the only thing investors need to be focused on.
Well, I'm glad you brought that up, right? Because Disney gave a pricing update that its streaming service will offer a bundle with Disney Plus, Hulu, and ESPN Plus for $12.99 a month, which is in line with Netflix's standard plan, so that could be a plus. But are you worried at all in terms of how it might compete? I know as we look forward to that streaming service in November, they've got a lot of content to throw up there. But will it be able to take share away from a Netflix when they actually launch? I know Bob Iger was mostly focused on this on the earnings call.
I don't really look at it as that way. I think it's really the end of cable as we know it. It's been dying for a long time, but this move by Disney by bundling Hulu, which has really 3 tiers of service, including live television, with ESPN and Disney Plus, it gives you sports, movies, and of course, all the television you could ever want. And then what most consumers will probably do is just keep their Netflix too. So with Disney assets plus Netflix for, let's say, $25 or $30 a month, you've got everything you need, and you already get Amazon for free anyways with Prime. So I think the real pressure is going to be on HBO and the other services. Like, I think they're going to have a really tough struggle against such a compelling offering. Netflix as well. I think Netflix's valuation will have to come down.
Well, there's one piece here, because Iger did call it the most important product that he's ever worked on, at least in his tenure. But I also wanted to ask, because he mentioned it specifically on the earnings call, about how he might actually team up with some of these partnerships with some big tech companies. He mentioned Apple, Amazon. Just want to play that and get your thoughts. Here's what he had to say.
There are others out there, notably Apple and Amazon and Google, for instance, that we've been in discussions with about distribution. You can expect that we will conclude deals with them as distribution partners. We think it's important for us to achieve scale relatively quickly, and they'll be an important part of that.
So off of that, the question being, it sounds costly if you're going to be working with other platforms. The whole idea here is that you have such strong content that you're going to be able to attract people to sign up for your service straight on Disney Plus when they launch. Curious to see if there's going to be an emphasis on really making money from the get-go.
Yeah, I think you're thinking about it sort of backwards. If you're Apple, why would anybody want to deal with your service? So by having add-ons like Disney, it makes the Apple ecosystem more compelling. And that's where I see a major deal with Apple and YouTube, because they have, Apple, I don't know what kind of service they're doing, but I think it's going to be free. So they need to make the revenue off of selling subscriptions like Disney. So having a global powerhouse like Google's YouTube and Apple pushing your product to billions of potential customers is only going to help Disney grow way, way quicker than if they were just trying to do it on their own. So these are just distribution deals. But you have to remember, for Disney, much of the content would be made either way. So when they put it on their streamer, in essence, it costs them nothing because they've already monetized the content, where companies like Amazon and Netflix and everybody spends all this money on content and have to monetize it through subscriptions. And so with the subscription revenue rising, and it will rise now every quarter forever, you know, this is a huge potential cash flow source for Disney over the next 5 years. You got to stop looking quarter to quarter with investing, because really the future is what you're investing in, and Disney's making a sweet move.
So Disney having these distribution deals that they're working out with Apple and Amazon, I mean, where does that leave Netflix? And also in terms of content, I heard that Disney is going to be bringing back Home Alone. So what do you think that kind of content is going to do for the streaming service?
Oh, it's going to be great. And you know, they were talking about High School Musical. They were talking about rebooting X-Men under Marvel. This is huge. I mean, look at the Marvel success that they've had. So, you know, when you really look at the overall, you know, situation Disney's in, they've got a lot of work to do for sure, integrating everything. But this is an exciting time. So if you're Netflix, you have to really reassess your business model now, because movies like The Irishman, which are going to be phenomenal movies, should be in theaters, and the movie would probably do $100 million in the theaters, and not getting that revenue is a big problem for Netflix, I think, longer term, where Disney's doing it the opposite, making all this monetization with their products first and then dropping it on the streamer and making even more money with it. So it's going to prove that Disney has the better model than Netflix, and Netflix is going to have to start looking a lot more like Disney.
Well, I mean, that's the interesting question. Real quick before you go, I know you've played both these names. You invested in both these names. Last time you were talking about shifting over, playing more Disney rather than Netflix. Is that still the case, or are you just completely off Netflix?
No, I mean, we own Netflix, and we've been long-term investors in Netflix and have more than taken our profits here and lowered our position a little bit here. But you know, long-term, Netflix is a winner. There's no doubt. They've done a phenomenal job with their business. And so, you know, when I'm talking about these companies, I'm talking mostly on a valuation basis, because, you know, Disney with a 20 PE or so and Netflix with 120 PE, and you look at the valuation of the DTC division of what Disney should be, and I'm thinking it should be worth $100 billion. And, you know, Netflix, on the other hand, I think should have more like a 50 to 60 PE ratio. And so the stock is mostly just overvalued. But as a business, I love Netflix, and I think the two winners in the space are Netflix and Disney, and that's the future for global entertainment, and that's what we're invested in.
And we didn't even talk about the parks. We just talked streaming.
Yeah.
There you go. All right.
Another gold mine.
Yeah, no, for
another
sure.
gold mine.
All right, Ross Gerber, thank you so much for taking the time. Appreciate it, sir.